Welcome back to Unit 3, General Principles of Insurance and Risk Management. In this video lecture, I will start out by discussing some fundamental legal principles behind insurance. I will then move into a review of the common parts of any insurance policy, and we'll finish with a discussion of additional risk management concepts. One of the basic legal principles underlying insurance is the principle of indemnity. Under this principle, the insurer agrees to pay no more than the actual amount of loss. The idea is that the insured should not profit if a loss occurs. This reduces and controls moral and morale hazard. If you can profit from a fire, you are more likely to start one. In property insurance, this originally took the form of the actual cash value rule, which is defined as replacement cost less depreciation. Over time, the industry has developed exceptions to the principle of indemnity while still maintaining the control over the negative influences of moral and morale hazard. Some of these exceptions are replacement cost insurance and property coverage. Actual cash value does not give you enough money to rebuild a building or replace its contents and can cause hardships in many cases. How the industry has addressed this issue is twofold. First, for the insured to qualify for replacement cost coverage, they have to carry a high enough limit to equal the replacement cost. In this way, the insurance company is able to get a premium that is on level with this higher exposure. Secondly, in the loss adjustment process, the insured will be paid the actual cash value of their building initially, but the insured only receives the additional higher value when they've actually rebuilt their building. So it's less likely they're going to profit from arson for hire. The next exception to indemnity is a valued policy, which is typically used with hard-to-value items such as art, antiques, or jewelry. It can be difficult to get a true valuation on such items, and they may be truly irreplaceable. So the insurance carrier and the insured agree ahead of time on a value that they're both comfortable with. The trick is that the carrier will agree on a value that they feel is fair, but not so high as to induce the insured to cause a loss just to get the payment. The third area where the principle of indemnity is violated is with valued policy laws. This was a consumer-driven issue in some states and basically says that if an insurance company has been collecting premium based on a limit of $250,000 for your house, they cannot come along after a loss and say that the true value is only $150,000 and that is all they will pay. This only comes into play with a total loss to the property. Otherwise, the company will just pay the cost to repair or replace the damaged property. A final example of insurance that violates the principle of indemnity is life insurance. There really is not a true way to fully measure the value of someone's life, so insurance companies don't even try. The moral and morale hazards usually work themselves out with life insurance, as people typically do not take out life insurance in order to kill themselves. The self-preservation instinct is usually strong enough that this does not come into play. In addition, underwriters usually only approve limits that they feel are roughly in line with the person's income stream and other benchmarks the industry uses. The next legal principle is that of insurable interest. Basically, if the insured stands to lose financially in a loss, they have an insurable interest and can buy insurance for the property or exposure. The main purpose of requiring an insurable interest before allowing someone to buy insurance is to prevent gambling and to reduce moral hazard. If you own property, you clearly have an insurable interest in it and can buy insurance on it. In many cases, people and businesses have an interest in property that is owned by others. Examples of this include the bank that owns my mortgage and the dry cleaner where I drop my shirts off for cleaning. In both of these cases, someone else has an insurable interest in property that I own. In the case of my mortgage, the bank has a direct insurable interest in the outstanding balance of my loan. As a recognition of that interest, my insurance company puts a special endorsement on my homeowner's policy that says if the house burns down, the insurance company will pay the bank off first until the loan is completely paid off, and then they'll pay the balance of the limit to me. The dry cleaner, by contrast, is not protected under my policy, but she can and does purchase insurance on her business policy to cover her liability for damage to my shirts while they are in her care, custody, and control. She is assumed to have an insurable interest in my property because she is responsible for it while she has it. Another issue that is important with the concept of insurable interest is the time frame when it must be met. With property and casualty insurance, to control moral and morale hazard, you must prove that you have an insurable interest at the time of the loss. In life insurance, by contrast, you have to have an insurable interest only at the time that you first buy a policy. The implication here is that you can sell or transfer your life insurance policy after you've bought it to someone else, and the insurance company has to recognize and accept this transfer. In property and casualty insurance, you cannot transfer or sell your policy to another person or business. Moving on to the next legal principle that I'm going to review is subrogation. Subrogation, I'm not sure if it sounds more sinister or just boring, but either way, it's a pretty arcane insurance term, but is a very important one in insurance. The basic concept is that the insurer is entitled to recover from a negligent third party for any loss payments that they've made to their insured. If your neighbor starts your house on fire by letting their bonfire get out of control, your insurance company is going to pay for your damage to your house, but then they will sue your neighbor to collect that insurance proceeds that they paid out. You could just sue your neighbor directly, but then you would have to pay for the lawyer and go through the time and energy. The insurance company has far more experience and expertise in doing this, and they will pay the lawyer. Often they will not even sue your neighbor. They will just reach a settlement with your neighbor's insurance company. The purposes of subrogation are to avoid collecting twice, to keep the insured from collecting twice in the loss. And think of the principle of indemnity here. The insured cannot profit. The second purpose is to hold the negligent person or company responsible, to punish them for their wicked and evil ways. And thirdly, subrogation helps to hold down rates by reducing the amount that insurance companies pay. Another principle that has always been important in insurance but is more difficult in these times is that of utmost good faith. Historically, a higher degree of honesty is imposed on both parties to an insurance contract than in other contracts. And where this becomes important is with the legal doctrines of misrepresentation, concealment, and breach of warranty. Representation by an insured is any statement made by the applicant for insurance. The insurance contract may be voided if that representation is material, if it's false, and it was relied upon by the insurer to induce them to offer you a policy. So when is it material? It's material if the insurer knew the true facts, then the policy would not have been issued, or if it would have been issued on different terms. Concealment means that there was an intentional failure on your part as an applicant for insurance to reveal the material fact to the insurer. You knowingly made a false statement. Now, a warranty is a statement to the insurance contract as guaranteed by the maker, you as the maker of that warranty statement. For example, a business that states that they have a great loss control program, such as surveillance equipment or security guard, or that their building has a working sprinkler system when it does not, and they know it does not. Now that we've gone over these concepts, let's talk about the basic requirements of an insurance contract. Many of these are requirements of any contract, which you may have already learned in business law. First, there must be an offer and acceptance. In insurance, the applicant usually makes the offer, and the insurer accepts or rejects the offer. An agent's authority to bind the insurer varies by the type of insurance. With property and liability insurance, the agent may have binding authority delegated to them by the insurance carrier, or he may have to give written or oral binding authority on each insured, or just for those insureds that fall outside of their regular guidelines. In life insurance, by contrast, the agent has to have written confirmation from the insurance company to bind in each and every policy. Now next, let's talk about the consideration that must be given. The insured's consideration generally is the payment of that first premium. The insurer's consideration is the promise to perform the contract should you have a loss. As with any set of contracts, there must be competent parties on both sides. And then finally, there must be a legal purpose. So you cannot insure a bag of marijuana, for example, since that's illegal property, and that'd be an illegal purpose. These are the same characteristics as any contract. And as you would imagine, there are special characteristics of an insurance contract. The first is that insurance is an aleatory contract, which means that values exchanged may not be equal, but they depend on an uncertain event, the loss that may never happen. Second, they are unilateral contracts. Only one party makes a legally enforceable promise, the insurance company. And insurance is a conditional contract. There are provisions that qualify or place limitations on the insurer's promise to perform. However, the insurer does not have to pay the claim if the policy conditions are violated. Those include notice of loss to the insurer and attempts to mitigate loss. And insurance is also a personal contract between the insured and the insurer. The insurance contract is not for the property, but for the owner of the property against the financial loss. And that policy cannot be sold or assigned to another party if it's a property and casualty policy. Finally, an insurance contract is a contract of adhesion. And that means that the insured must accept the entire contract with all of its terms and conditions. It's a take it or leave it basis. Because of this, any ambiguity is strictly construed against the insurance company. Court cases, judges try to side with the insured since they did not have the ability to draft the contract. And the only time this does not come into play is when you have a very large and very sophisticated corporate insured when they have directly negotiated the wording of their insurance contracts with the insurance company. Let's now turn to law and the insurance agent. If you would have business law, you spent a fair amount of time talking about agency relationships. All those concepts apply here with some additional nuances in case law that is built up over time. With insurance agents, there is no presumption of an agency relationship unless the insurance carrier has given materials to the agent that would give you the impression that the agent is acting as an agent of that carrier. Authority to represent the principal. As in any agency relationship, the principal, the insurance company, is responsible for acts of their agents. So what does that mean with insurance? When they're acting within the scope of their authority, the insurance company is going to be responsible for fraudulent acts and omissions and misrepresentations that the agent may do that takes him or her outside of their agency authority. So the insurance company is still going to be bound when they do these things. Knowledge of the agent is presumed to be knowledge of the principal, the insurance company in this case, with respect to matters within the scope of the agency relationship. So if you tell the agent something negative about your driving record and they don't tell the insurance carrier is bound. Although if it's a material fact, the insurance carrier may sue the agent and cancel their business contract with the agent, but they still have to honor their policy with you. With these legal principles down, let's turn to the basic parts of an insurance contract. Every insurance contract is going to have the same basic parts, and once you have them and know them, it is easier to evaluate and understand a new insurance policy. Those basic parts are declarations, definitions, insuring agreements, exclusions, conditions, and miscellaneous provisions. Declarations answer the who, what, and when questions. Who is insured? What is insured? When is it insured? The declarations will include such things as the policy number, the policy inception and expiration dates, the name of the insurance carrier, the name of the agent, your name is insured, your address, and it'll include a description of the property that's covered. Also list the attached forms and endorsements. We'll include the policy limits and any deductibles, and any additional persons with an insurable interest, such as a lien holder or business partner. Next would be definitions in the policy. Many words in an insurance contract carry their normal meanings, but there are some words with special meanings, such as flood and earthquake. Some people think these are weasel words. The phrase, and it depends on what the definition of is, comes to mind, but part of the reason for definitions is that over time, courts try to expand coverage and interpret words to mean things that they were never intended to. Insurance companies have responded by bringing the definition back to what they originally intended. Definitions then assign meaning to policy terms, and they can appear in the preamble, the glossary, or throughout the policy. If a term is not defined in the policy, consideration would be given to local, cultural, and trade meanings. Insuring agreements, next, are really the promise of what will be paid. They state under which circumstances the insurer will make a payment and will provide a service. And there are really two major forms. The named perils policy, which would mean that only those perils specifically included and named in the policy are covered. So the insured then has the burden of proof to show that the loss was caused by a named peril. By contrast, the all-risk policy or special policy has a form where all losses are covered except those that are specifically excluded. In order to deny payment, the insurer must prove that the loss is excluded. This is the type of policy you want for yourself and your business. You do not want to accept the named perils policy. It's a bad form because you want the burden of proof to always be on the carrier rather than on yourself. Next are exclusions. And they include any policy provision that eliminates coverage for a specified loss exposure. Exclusions clarify coverage by indicating what is not covered, but at times they may also add back coverage through exceptions to exclusions. So why do we need exclusions? They eliminate uninsurable loss exposures such as war and intentional acts. They control morale hazards, and they eliminate coverage duplications between standard policies. For example, exclude auto off the homeowner's policy. They also eliminate unneeded coverage for typical purchasers, such as boats. Most people don't have boats, so they don't want to have to pay premium for coverage for that. They eliminate coverage that requires special underwriting and rating, such as for motorcycles. And exclusions really keep premiums affordable, because why should you pay for coverage if you don't need it? Now next are conditions, and they qualify an otherwise enforceable promise of the insurer. They can include the insured's duties, such as to pay premiums, report losses promptly, document their losses, and mitigate damages, as well as cooperate with the insurer. The condition precedent is we, the insurer, have no duty to provide coverage unless there is full compliance with the following duties. Or it could be a condition subsequent, which terminates an existing obligation if a particular event occurs or fails to occur. And finally, there are miscellaneous provisions such as cancellation and subrogation, which we've already discussed, and policy procedures, such as methods of measuring a covered loss. Many insurance policies also contain deductibles, which require the insured to pay a portion of the loss. The deductible amount typically would be subtracted from the total loss payment. Now, why are there deductibles? Why do insurance companies put deductibles on policies? First, they eliminate small claims and maintenance type claims. And by reducing the amount of loss and expense to handle loss, they reduce premiums. They also reduce moral and morale hazards. And there may also be a coinsurance clause in your property policy. These clauses are meant to encourage an insured to carry a limit of insurance that is approximately equal to the value of their building or house. Whether it's on an actual cash value or replacement cost basis, doesn't matter. There typically is a coinsurance clause on it. If the insured does not carry a high enough limit in relation to the value of their house, their loss payment may be reduced by a coinsurance factor. So why do insurers use these clauses? Well, the rates contemplate full insurance coverage, so they want to make sure that underinsurance does not result in a lower premium than is actuarial sound. Let's now turn to risk management, enterprise risk management, and financial risk management. Over the last 10 years, many corporations have become more sophisticated with their risk management programs and have started to look at all of their risk exposures together rather than having one department look at insurance, another look at financial risk, and still others look at operational risk. The thought is that there are efficiencies to be gained by looking at risk in a bigger picture, and that if some are uncorrelated with others, then companies can retain more risk themselves, leading to a lower cost of risk. That is the theory, and it is much harder in practice than it sounds. Let's look at the details of some of these concepts. Financial risk management is defined as the identification, analysis, and treatment of speculative financial risk. There's always two sides to speculative risk, a sell and a buy, and they are often natural hedges to each other. Commodity risk is the financial risk and is the risk that the company loses money from a change in the commodity price. You will notice that I did not say by an increase in the commodity price, as it depends on whether the company in question buys or sells the commodity. In a similar way, interest rate risk is the chance of loss from a change in interest rates. When interest rates go up or down, there are winners and losers, and often they both have incentives to hedge against this risk, providing natural partners in a risk management technique. Another financial risk is currency exchange risk. Again, the risk is a loss from a change in the price of a foreign currency. With financial risk, there are always winners and losers. One company's loss is another company's gain. And managing financial risk has typically been done by the finance department and often included capital market instruments that are commonly referred to as hedges. Hedges can be options contracts, contractual terms such as call features and bonds, futures contracts, and forward contracts. In the last 10 to 15 years, both the insurance industry and capital markets firms have been working towards solutions to risk that have begun to address both financial risk and traditional insurance risk. An integrated risk program is one such approach that combines higher retentions for the company with coverages for both types of risk. Part of such a program is a double trigger concept, whereby coverage is not triggered unless there's both a property loss and a financial loss, such as a currency exchange loss. The enterprise risk management thinking behind such a product is that the company can handle one of these losses by itself, but not both at the same time. The premium for an integrated product is much lower than insuring either event by itself. We'll talk more about ERM as we move forward with this class, but the main concept to keep in mind is that an organization should be evaluating all of its risks, not just those that an insurance company is willing to sell it insurance for. As an example of ERM, let's now look at the insurance industry and the special risks that it faces. The insurance industry specializes in evaluating, measuring, pricing, and assuming risks, and through the law of large numbers, it can reduce risk by combining many different exposure units together. A unique risk, too, and feature of the insurance industry is the underwriting cycle. Companies refer to the underwriting cycle as being either a hard or a soft market. In a hard market, prices are rising, insurance is hard to get, and insurance companies start making money. In a soft market, prices are falling, and insurance companies eventually start losing money. The insurance company's combined ratio, which is the loss ratio plus the expense ratio, is a basic measure of whether an insurance company is making money or losing money. Anything above 100% means the company is losing money on underwriting and needs to make up for it with investment income. In the 1970s and 1980s, this worked as interest rates were high, but today with low interest rates, companies cannot cover underwriting losses with investment income very easily. It would seem that insurance companies should be able to look at prices and their combined ratios and conclude that if prices are too low, they should just sell less insurance and wait for prices to come up. In practice, this is very difficult to measure in time. Often the industry's success at one point is shown by high profits, and this leads to a soft market and losses eventually. The concept of capacity and surplus come into play here. As insurance companies have profits, Their surplus increases, and so does their capacity to write more new business. As they compete to write new business, they drive prices down, thus starting down the path of the insurance cycle again. Insurance companies interface with the risk of the underwriting cycle, as well as interest rate risk and investment risk. Add in the risk that a huge hurricane will destroy the Northeast, or that an earthquake wipes out Los Angeles, or tornadoes move through the Midwest, and you have a very interesting series of risks that the industry faces just about every day. Risk management is an issue for any company, big or small, regardless of the industry. Every organization faces risk and has to decide how to best manage those risks. Now let's talk about risk management in practice with a couple of examples to work through. In our first situation, let's look at a local nonprofit group, your local ARC or ARCH, which is the Association for Retarded Citizens and Handicapped, and their use of property. Typically, they're going to rent office space and own office furniture and equipment, including computers. Now let's look at the different risk management techniques, find the best way for them to handle the risk of loss of this property. So the methods that they could look at are avoidance, just go out of business, loss control, loss prevention, which would include locks and located in a low crime area, loss reduction, which would be putting in burglar alarms, a retention, they could self-insure the risk of loss to computers, non-insurance transfers, they could transfer risk by contracts, hold harmless as indemnification. It's probably hard to do that in this case. Hedging, no, it's not applicable here. Incorporation, doesn't really work for the exposure. Insurance is really the only choice, or the probably the logical choice in this situation. Let's stay with the same organization, but talk about liquor liability. This nonprofit has one main fundraiser every year, a big dinner with a live auction. The alcohol is typically flowing as it helps people open up their wallets during the auctions. And the risk here is a liability one. Someone drinks too much and gets into an accident on the way home, they may try to sue the nonprofit organization, as may the person that they hit. So what are the methods that we can evaluate here? Avoidance is always the first one to think about. But if you avoid it, you avoid the money that the fundraiser raises. We need to talk about loss control here. Loss prevention, we could ask for identification from everyone. Loss reduction, we could have trained bartenders who cut people off if they have too much to drink. Next, retention. Probably not a good idea here. There's non-insurance transfers. Could transfer the risk by contract. We can hire a caterer and then transfer the risk to the caterer, which is a good idea. And insurance. No matter what you do, we also want to make sure that they have insurance. Now, in the world of risk management, there are always new and emerging risks to be concerned about. Kidnap and ransom is becoming big these days, particularly in places like Mexico and the Mideast. Reputation concerns and security concerns are big for corporations. Methods of handling risk are changing as well. And we will discuss those further in the units ahead. And once again, I appreciate your time for this unit and look forward to seeing you in the next unit.